The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks Investors Observer members only workshop. Welcome. Let's get started. This is our agenda for today. We've got some charts, talk about what else is happening in the market, look at what sectors and industries are hot right now. The rest is member-driven content. So we got a bunch of good questions ahead of time. Thank you to those who sent in questions. Otherwise, you can put questions in the box at any time, either, now when something pops into your head, or just, if you have a question about while I'm talking. I got 2 screens here, so sometimes if you put a question in while I'm talking about something, I can get to it in the moment. Otherwise, like I said, there'll be plenty of time towards the end. Before we kick things off, we did get a late question regarding apps. Yeah, regarding apps, we are working on an Android app. We hope to have that out in a matter of weeks. Let's say maybe a few more. We'll see. Software development is complicated. And then we have a bunch of other projects that we may work on. Some of those may include adding things to the existing apps. Some of those may include enhancements to the product that will go across all 3 platforms. I don't really know what the next piece is going to be as far as that goes, but the Android app is coming soon, and it will be just the stock stuff in the same way that the iOS app is currently. All right. So charts. I pulled these this afternoon. There was a lot of sort of chop in the market after the Fed meeting. So yeah, this last daily candle may not be entirely accurate, but it's probably pretty close. So yeah, we've gone a long way. I'm trying to remember when the last workshop was. I think we've come off this bottom since the last time we had a workshop. Come up and kind of stalled out a little bit on the S&P 500. Some of the other indices and some individual stocks have either set new highs or gotten back to be pretty close to highs. So that's generally a positive. As we'll talk about a little bit later, there is obviously kind of a lot going on. So yeah, we'd like to see maybe less of these big gaps, but generally I would say we're still at a level where I wouldn't say the recovery here has really broken down yet. So that's something. Yeah, the NASDAQ tech has kind of lagged a little bit more. Tech also peaked earlier and was down further. A lot of this has to do with the Federal Reserve, which we'll be talking about more a little bit later. But yeah, speculative tech stuff, which is a lot of the NASDAQ, is not doing so well. And then the other thing that happens is a lot of the big tech stocks were sort of the big winners from the pandemic era. And so they were maybe a little bit overextended, and people have been looking to put money elsewhere. All right, the Russell 2000 is kind of interesting. Here's the 1 year. Okay, so we spent almost all of 2021 in this range here, and then dropped below it when the market fell to start 2022. And we've been in kind of a range since then. We broke back up into the old range, which was kind of nice, but you can see we broke down trying to get above this level where we had some support before the market collapsed. So that's kind of interesting. And then we can look at the 3-year chart. We're still sort of in a channel that's above the sort of pre-pandemic trend. The Russell 2000 in particular is interesting because it is the way they get the Russell 2000 is they take the biggest 3,000 stocks and take the top 1,000 off. So it's essentially the 2,000 smallest companies of the 3,000 largest companies. There are some relatively small companies in there, it turns out. Not a lot of, real micro caps, but, some pretty small companies. And so what that means is, right, if you have something like an Apple, right, you don't get the companies at the top of the Russell 2000 don't double their market cap. They get kicked out of the Russell 2000 when that happens. So it's not super surprising to necessarily see it not have big gains and stay in kind of a range because things get promoted out of it. But you would like to see it not do this, for example. All right, the S&P 500 versus the equal weight is kind of interesting. This is the last year when the market sort of peaked. We had the S&P 500, really sort of outperforming. There's this big gap here between the equal weight and the S&P 500 sort of classic in blue here. But then we got to a point where it was basically at parity for the year in sort of the second week of March, where things, when the market kind of bottomed, and then on the rebound, the cap-weighted index, which is the regular S&P 500, has outperformed a little bit. And what that typically means is that the biggest stocks, which are your Apple, Microsoft, et cetera, are doing a little bit better than sort of the other 495 or so. All right, growth versus value. Maybe not surprising here. Growth was really hot and then was really less hot, right? This is a little bit of the reverse of this, where we had the cap-weighted stuff outperforming and then it hit parity at the bottom. In terms of what we're looking at here, we have growth in blue was way outperforming, and then at the bottom was underperforming, and you can see this switch more recently. This is kind of interesting, I think. One way to think about growth versus value coming out of the pandemic was that growth is all your tech stuff, all the the Zooms and Pelotons and Netflixes and some of those things where people are like, oh, well, if everybody's locked in their house, these are the things they're going to need. And those actually peaked earlier in 2021 than here. But then there's a pivot to some sort of different tech stuff, electric cars, some of those things. And those are all the things that really got hammered in the market sell-off, whereas value tends to be companies that are growing slower, but things that are more tangible, right? Like actual stuff, as well as some services that aren't internet services, let's say, airlines, transportation, that kind of thing. So yeah, we went from way high on the value to way low, and that value tends to be more volatile than, or growth tends to be more volatile than value. That's not super surprising, and now we're at a little bit of parity, but this spread here in the last week is kind of more interesting. And I tried to capture kind of a different version of that here. Okay, so JET it's an airline ETF. It has the airlines and a couple of other sort of travel-related names in it. And then the blue line here is XLE, which is energy stocks. And you can see these things tracked relatively well. So this is the last 3 years, actually, not 1 year. Sorry, I mislabeled this. They tracked relatively close together through the pandemic, and the reason for that is oil, which is most of the energy sector, is basically a transportation fuel. So if you're looking at a big drop in demand for transportation, it makes sense that both the transportation companies and the oil sector would take a hit, and then as that recovers, you see them recover together, and then you have this big divergence here. Obviously, I think everybody knows gas and oil prices have gone up recently for a bunch of reasons, and the transportation stuff has been stagnant, right? Like I don't think it's necessarily rolling over in the way that this kind of implies. I just think it recovered and now it's maybe a little closer to business as usual. And then also you get to a point where oil prices are real high and it's actually, this is no longer, this divergence I think means we're no longer tracking a recovering economy. We've got a different story going on here, right? So the fact that these diverge similar to this divergence here kind of means that something is changing a little bit. Here, obviously, we have people worried about inflation. We have oil prices spiking, which is bad for airlines. But also, right, like transportation growth, I don't think is going to come back to a pre-pandemic level, or airline usage isn't going to come back to pre-pandemic level particularly quickly, just because I think a lot of people realize that some amount of business travel is unnecessary. Some amount of daily commuting is also been sort of shown to be unnecessary, although I think that has a certainly a smaller effect on the airline ETF, but also a smaller effect on oil demand. All right, so what else is going on? I think we all kind of saw today the Fed is kind of back in the driver's seat. The Fed inflation interest rates bullet here had kind of moved lower for the last couple of workshops, but we're back to the Fed on top now. Yeah, I wrote these slides before the minutes came out. So yeah, I would change seems to be getting more aggressive to just definitely is getting more aggressive. The Fed minutes today didn't have a ton of surprises. It's maybe interesting that it seems like they probably would have done 50 basis points at the last meeting instead of 25. They did 25 essentially because the Ukraine thing was very fresh. But I would, fully expect 50 in May. And then balance sheet runoff is going to start soon as well. That means all those bonds and mortgage-backed securities that the Fed has been buying. They're not actually going to start selling them, but there are bonds, which means that they pay a regular coupon. Those coupons get returned to the Treasury. That's how that works. And then what happens is when the bonds expire, they roll the principal over at auction. So what balance sheet runoff means is essentially instead of taking the cash you get when a bond expires and buying another bond, they're just going to retire that, return that money back to Treasury. And that's how the balance sheet sinks. There was some talk about maybe selling some mortgage-backed securities to get down to a place where it's, they have some percentage of the balance sheet they would prefer to be Treasuries, and then a much smaller piece to be MBS. So they've talked about maybe selling some of the mortgage-backed securities, which might push interest rates higher. It's really hard to know how that would affect markets, but they said not until the balance sheet runoff is, I think the phrase was well underway, which I don't know exactly what that means, but I would assume it means probably not in the next, meeting or two anyway. And yeah, it's hard to know if that will cool off the housing market. Mortgage rates are going up and the housing market is still crazy, and it's really because we've just underinvested in housing supply in this country for quite some time. It turns out that everybody is born short housing, and they need to cover that short at some point, and we just haven't been building fast enough to keep that up. All right, but yeah, so the Fed's getting more aggressive. That's back to really pushing things around in terms of the market. That's, I think, why you see a little bit of this new divergence here. Is value stocks maybe tend to have a lot more sort of unprofitable tech names, whereas your growth stocks, that's backwards. Value stocks tend to be steadier, pay dividends, things like that, whereas growth stocks is where you'll find a lot more like unprofitable technology names and other companies that are highly levered, so more susceptible to a tighter funding environment. There are a lot of positive signs on the shipping front as far as interest rates go. There's been some huge moves in trucking recently in terms of There were some reports that came out earlier this week about sort of the number of truck drivers going up and freight prices going down a lot, which suggests that that market is less tight. That may help with some of the inflation stuff. It may lead to a little bit of a crash in some of the trucking sector. Trucking is a thing that it's relatively easy to get into. You get a truck and you get a license and now you're a trucker. So if freight rates get really high, a lot of people go into that business and then it kind of crashes. It's like a lot of other things where there's a little bit of a boom and bust cycle. But there are still a lot of things, like I said, it's looking good on the shipping front or looking better on the shipping front. But there's still a lot of things on the, a lot of other things that are potentially keeping inflation high. Energy costs, food costs, some of those things I kind of expect to remain high. There's just a whole bunch of things. Ukraine and Russia both export some amount of oil or some amount of wheat and some other grains, which while the U.S. doesn't necessarily import a ton of grain, even if you're importing a very small percent of grain, you're still exposed to the global market, and prices tend to kind of move around to match, whatever the high bid is there. And then there's also stuff like there's a bit of a bird flu outbreak going on in the U.S., which has pushed chicken prices up. Some other weather-related things that have led into some of the agricultural commodity prices. So yeah, there's still a lot of weird stuff going on that could keep inflation elevated. The Russia-Ukraine thing, I think everybody has kind of dealt with in terms of prices in the market. Obviously, it's a potential source of volatility at any moment, particularly in commodities. And maybe some new sanctions announcement could move some commodities around, which could spill over into stocks. But I think at this point, to get a big volatility event in stocks out of Russia, Ukraine, you'd need some sort of big escalation or some other unpleasant surprise to get any kind of big move to the downside. And then I don't know, I guess some sort of instant into hostilities would probably get you a relief rally, but it seems unlikely to happen anytime soon. China remains kind of an interesting wild card. They seem to be trying to play both sides in terms of not trying to cut off Russia as much as the West is, but also trying not to cozy up to Russia so as not to alienate the West. China's economy is also still struggling. I don't know if you remember last year, there was a lot of news stories about some real estate firms that were struggling. Those, it turns out, are still struggling. And also China has sort of pursued a zero COVID policy in terms of just shutting things down and making everybody stay home when they get COVID outbreaks, and that is not working. Their vaccine is also much less effective than the Western vaccines. So they're doing rolling shutdowns. Big parts of Shanghai are shut down. They've shut down some other stuff in sort of the Shenzhen area where a lot of industrial activity happens. So there may continue to be spot shortages of some goods. What's interesting is some slowdowns in China outside of those spot shortages of some goods could be a positive for some inflationary factors, right? Like if China's economy slows down, they're using less oil, they're using less steel, they're using less of some other things. That may take some of the inflationary pressure off of the rest of the global economy. And China's economy is heavily centralized and manipulated by the government, though, so it's unclear how willing they're going to be to really let their economy slow down. They've built entire cities where they didn't exist before as a way to just sort of keep the economy going in the past, but with their real estate sector kind of struggling now, it's hard to know what levers they may have to turn in that regard. All right. So the stuff that's hot right now, the top of this list didn't really change. I think oil and gas drilling swapped places with exploration and production. Those are really pretty similar. industries. Thermal coal remains at the top. I think it's actually gotten stronger in the last couple days after some more countries moved to try to stop imports of coal from Russia. So that makes the other coal companies, prices higher. Utilities, I think there was some brief shuffling here, but it's not much different. This is about essentially, some of it's about energy, but in the US it's mostly, I think, about sort of safety and interest rates. Utilities tend to be pretty stable. Dividend payers, they're definitely in that value stock sort of vein. If you want to think about that, so they're safe when people are worried about the things that are going on in the world and worried about valuations of other stocks. Utilities can be a pretty safe place to park some money that in a lot of cases may outperform fixed income investments without having the just on a dividend basis, without having the volatility of tech stocks. Real estate, I think retail popped up here to replace specialty REITs, but it's basically the same. And this strikes me as being very similar to utilities in the sense that the economy in the US is doing pretty good. Unemployment is low. People and companies should be able to pay the rent by and large. So this is a place where you should be able to park some money relatively safely and collect dividends. REITs have a special tax status, which means that they pay out most of their free cash flow in dividends. Basic materials moved up. Yeah, financial services had been in that fourth spot for quite some time. Basic materials moved up into there. And this is where the war in Ukraine really shows up. It's aluminum, which is a big export of Russia's, coking coal, which is used in steel making, and agricultural inputs, which is fertilizer, basically. Fertilizer, obviously, I talked a few minutes ago about shortages of some agricultural commodities, and then also it's made from natural gas in a lot of cases. So, the prices are just higher there. And then financial services gets bumped down by basic materials. Industrials is what actually got moved off the list this time through. And yeah, financial services do well when the economy is doing well. And in the US, the economy is doing pretty well. Maybe too well is really the problem we have now, right? Like that's why the Fed is talking about raising interest rates. All right, before we move on, let's dump out of this and I'll show you where this information comes from. If you go to stocks and then sectors and industry, you can see a list of sectors and the industries listed by the InvestorsObserver scoring system. You can look at, fundamental. So for that list I just ran through, that's the short-term technical score. That's basically how things have been trading over the past month. And you can click into a given sector to see the industries listed over here in order by that same score. So that's where that comes from. I find this to be pretty useful to get a good idea of kind of what's going on and where money is moving in the market. All right, so that is all the slides I prepared. So now we're on to the questions. Like I said, if you have any questions, drop them in the question box at any point. And yeah, I'll either get to them at the end or I can, interrupt myself. So this question was from Gary. He had some questions about CBOE Global. He says, looking to invest in the stock, what are the metrics / valuations that would be used to analyze the stock? So CBOE it used to be the Chicago Board of Options Exchange. It was a nonprofit for a long time, and then they went for profit, and then they IPO'd at some point several years ago. They are primarily running an options exchange. They also license the VIX and some other volatility indices, which that index licensing has become a pretty profitable business for CBOE. S&P also makes a lot of money from just licensing various indices, but the volatility products have been pretty big in the last several years. It's really yeah, if you're trying to, I typically don't start with a stock. I typically try to look for things and then work, finding the stock is the last step in the process. So when somebody has a stock they like, I tend to want to know, why do you like the stock? And for that, what I really mean is kind of what's the story, right? Like, tell me why you like the stock. Is there some metric you like? Is there some thing happening in the economy that you think will be good for stocks in that sector or industry? What's going on there? And from there, the question is, does the story make sense? So in the case of CBOE, you can say, all right, things are pretty volatile right now. We can go back, if you'll bear with me scrolling through a bunch of slides. We can go back and look at the S&P 500 and say, there's a lot of up and down here. There's a lot of big candles, right? Like all of that typically leads to more options volume. And oh boy, also if you're licensing something used by volatility products, there's probably a lot of demand for volatility products right now too. So in terms of the story, that seems like a reasonable story, a good reason to like CBOE. And it kind of makes sense. The downside risks are another thing that I worry about in terms of story, right? Like what would make this story stop being true? And the risks here seem to be that maybe volatility goes down. It tends to be kind of mean reverting. If you look at a chart of the VIX, it doesn't look like a regular stock chart where it tends to keep going up and to the right. It tends to, have spikes and then settle back down to a certain level. But retail options trading continues to grow. So it's hard to know exactly when things will sort of stop being good for the CBOE as far as that goes. And the other thing when somebody says they like a particular stock is how long do you think you want to hold this stock, right? Like my guess, based on the fact that Gary submitted this question over a week ago and said, hey, I'd like you to talk about this in the workshop, means that he's not necessarily looking to, day trade it. So it's probably a longer term thing than that. But, if you're looking to day trade, all that stuff I just said about volatility may or may not really mean anything. Because if you're looking to day trade, you really don't care about the story behind the stock. What you care about is probably much more technical factors from looking at the chart than any kind of, trying to discern the macro business kind of sense. So, if it's a stock you like because of the story, you're probably going to look at holding it for a shorter time, or for a longer time, excuse me. For a shorter time, I don't think the story matters that much. So yeah, based on, but does that time holding match your story, right? Like, if you think there's just going to be a secular long-term increase in trading in options and volatility products, hey, CBOE is great. Buy it, hold it for a long time. If you think things might be hot for a couple of weeks, I can also see where that story might be the case. So yeah, that seems like it works in the case of CBOE. But also based on time, you can use the InvestorsObserver scoring system, right? So for long-term holdings, you want to look at things like the fundamental score, valuation, analyst scores. And for shorter-term holdings, you want to look at the technical scores and the sentiment. So we could do that here. All right, so CBOE doesn't do great in terms of fundamental or analyst rankings, has no valuation score, which is because it doesn't seem to have a PEG ratio. So it has a PE ratio. So what that tells me is most likely it has a 0 or perhaps a negative growth rate, which that's what would cause us to have no PEG ratio here. So that means that company hasn't really been growing. We can look at the chart here and see that over the last 5 years it's been up and down and up and down, which kind of reflects a company that isn't really growing. So that may be a reason you wouldn't love it for a long-term holding. The dividend is less than 2%. In this case, it looks like really maybe, right, all that stuff I said about the story in terms of, right, like volatility is high, retail options trading is growing. The market knows all of that, right? Like I didn't say anything that isn't pretty well known and in the news a lot. So yeah, I mean, given these peaks and valleys, I think, I don't know. I don't think I would buy CBOE here. I think I'd wait for it to pull back a little bit. It seems like the market kind of knows, you know, you didn't get to that story first, basically. So yeah, I don't love it on that level. You know, just looking at it and looking at the scores and kind of what's going on and what's happening here, that there's not, doesn't seem like a lot to love there, but that's also some insight into kind of the process that I tend to use, try to how I think through stocks and analyze things. All right, so Art said he wanted to learn more about bull call and bear. That is not right. Yeah, bear with me just a second here while I fix this. I edit these questions sometimes. They come in not typed particularly well, or with maybe more more words than are necessary. All right, well, I updated it, but it's not changing. Anyway, we're going to talk about bull put and bear call spreads. So these are the vertical credit spreads that show up in the Investors Keyhole trades that get emailed to our elite subscribers 4 times a day. They're also available in the options screener. Yeah. And they show up occasionally in the options portfolios as well. All right, so these are both, like I said, credit spreads. Essentially, the way they work is you're going to sell the one with the strike price that is nearer to the stock's current price, and then buy the one that is further out. Okay, so for bull put spreads, this means sell the one with the higher strike and buy the lower strike. For bear call spreads, this means sell the one with the lower strike and buy the higher strike. Since the sold option is closer to the money, it's going to have a higher price. This means you're selling more option than you're buying. And so you get paid to open this trade, right? This is a credit spread trade. So most investments, you end up, right? You open it for a debit, you pay to buy something. Whereas in this case, you're getting a credit up front. So that makes this a little bit unusual. Now, since you're getting a credit up front, you are essentially net short the options, right? That's how that works. You're selling before you're buying. So the goal here is for the value of those options to go to 0. Options have an expiration date. If your options are out of the money, which these options are all out of the money when we open the trade. If your options are out of the money when the options expire, they just go away. Right? So that is the price going to 0. So that's one of the reasons people like these trades is conceivably you only really ever have to do one thing, and that's open it. You know, you should absolutely understand how to get out of it. You should, you know, keep an eye on it. But if everything goes according to plan, then you only ever really have to do one thing here. That means, among other things, only paying one set of commissions. All right, so you can close it early. All you're going to do is just buy the one you sold and sell the one that you bought for, you know, hopefully a smaller price than your credit. Closing early will, right, like, turns out that paying to close the trade versus having the options just go away will result in a smaller profit. But that is how to close it. And yeah, since the plan is to let these options expire worthless, you don't need to spend a lot of time marking these to market. So, sometimes you open a trade and, right, you've got two options and the prices of the options change independently, and people call me like, I'm trying to do this subtraction and I don't, like, right? Like, yes, the prices of the options change. And you're trying to subtract them to try to figure out what it's worth now. But the plan isn't close the trade the day after it opens. The plan is hold the options to expiration. So you're certainly more than welcome to do a lot of subtraction if you want, but what you really care about is what we're going to talk about on the next slide, which is how to sort of keep track of these things. Okay, so this is the sort of, right, this shape here is the profit and loss chart of the essentially any credit spread. Right, so this is profit in dollars, this is the stock price, also in dollars. So above the strike price of your sold option, in this case the put, it would be below the strike price for call, but let's stick with the bull put credit spread because that's one we use most in the IK trades. Above the strike price, the options expire worthless. You keep the credit you got when you open the trade, right? The profit doesn't keep going up as the stock goes up, but that's fine. Below the strike price of the option that you bought here, the put that you bought, you have a full loss, but it doesn't get bigger as the stock keeps going down, right? It's relatively constrained. And it's constrained by, as I sort of implied by just saying that there, the width of the strike prices. So most of the time, occasionally we'll have a $10 spread in the IK trades on something that's kind of a high price stock. But typically it's going to be $5 or less. So that means the most you can lose is going to be $500. But you got that credit up front, so it's actually less than that. So the most you can lose is $500 minus whatever that credit was up front, which is usually more than $20. So like $480 is the most you can lose here, and typically it's going to be less than that. So yeah, what's happening here is the sold put is a bet that the stock won't fall below the level of that put. So I just talked about doing a bunch of subtraction to figure out how you're doing. What you really care about is what's the stock price, what's the strike price of my sold put. Is the stock price above that strike price? If it is, then you're good. Now, if the stock price keeps going down and it starts to look like it might expire below the strike of that sold option, then you might want to bail. Okay, and you're going to bail by buying the one you sold, selling the one you bought. That's when you want to get out. But instead of trying to track the prices of two options that are moving independently and figure out how you're doing today, the plan is hold these through expiration. So to actually track how you're doing is, all you really need to know is the stock price still above the strike price of my sold put? If it is, you're good. You don't need to do a bunch of subtraction and try to figure out how much you're going to get from the market maker out of two different bid-ask spreads. Don't worry about it. All right, so we sell the put. That's a bet that the stock stays above that price. What happens if the stock doesn't stay above that price is the put contract is enforced. We have to buy the stock at the strike price. Our cost basis ends up being the strike price minus whatever that credit was. So let's say we have a $25 strike price. We got a 20-cent credit. Our cost basis would be $24.80, right? It's 20 cents because we got 20 cents in. We have to buy the stock at 24. That's the cost basis. Okay, so the reason we buy a put is it caps that loss. Okay, so if the stock goes, so let's say we sell the 25 and we buy the 23. Okay, so now between the two strike prices, we have to buy the stock at 24, at 25. Our basis is 25.80, whatever. But we can lose money all the way down to 23. So the most we can lose on a $2 spread with a 20-cent credit is $1.80. Below 23, the put that we bought kicks in. So we buy it at 25, we sell it at 23. We're out $2 a share, $2 a share, but we got that 20-cent credit going in, so it's $1.80 per share. So that's how that works. There are a couple of articles in the Learning Center about this also, if you're interested in those. But yeah, that's the 5-minute course on trading credit spreads. Oh, all right, so Jim had a trio of questions, I think. He said, can you talk about how to use the out-of-the-money calculator and the enhanced chains under option trades? First of all, just so people know what I'm talking about, if you have the Elite Option subscription, you have this Option Trades tab, which lists all of these trades. There are potentially 7 of them. I believe this one that's missing here today is the Iron Condor. It means we couldn't find one that worked for CBOE. But these 2 buttons here, the out-of-the-money calculator and the enhanced chains. The enhanced chains look like this. It's like an option chain, but it shows you covered call trades and diagonal spreads. The out of the money calculator looks like this. You can put in a cost basis, so this presumes that you already own the stock. So let's say you bought the CBOE for $100. You'd like to get a little extra income off of it. Put in your cost basis, hit income generation, and calculate. And it suggests a call that you can sell against it that has a relatively low probability of assignment. In this case, it's 29.6%. All right, so the OTM calculator is for stocks you already own, like I just said. It's designed to either help you generate a little bit of extra income with a low probability of assignment, typically less than 30%. It will give you some slightly different info based on your selection of income generation or position repair. So if you select position repair, it won't let you sell a call that would result in a loss if that call were to be assigned, but it does the same basic thing in that case. The enhanced chains, everything is calculated as a new position. So the reason I would use the enhanced chains is for some reason you don't like the covered call or bullish diagonal spread that we highlighted. It's longer than you want, it's shorter than you want something further in the money, further out of the money, something like that. The enhanced option chains will give you that, and it makes it much easier to pick your own trade and compare trades. Let's go back to the enhanced option chain here. A second. All right, so for covered calls, we have a list of not all the expirations here, but most of the expirations, and we highlight a couple, right? So this, like the 112 here, whatever color that is, blue maybe. The darkest one is going to be the one that sort of we like the best. It's the closest one to what our algorithm would pick at that particular expiration. And then this sort of middle toned one is going to be one we like that's maybe a little bit more aggressive, it's a bit further out of the money. And then this lighter one is going to be the one that is probably a little bit in the money. But yeah, you can look at different expirations and you can get an idea of, the cost, the moneyness, but also downside protection, annualized return, and the P&L for all of these trades as well. All right, so that is question 1 from Jim. Question 2 from Jim was, could you talk about the difference between the personal and featured option trades? I understand the personal trades can be customized, but how are they in the featured trades selected? So I'll show you where these are in just a second. They're on the options dashboard. Both of these are designed as entry points to finding trades. They're trades that come from our big algorithmic process that runs overnight that selects thousands of trades across those 7 strategies I just talked about on the CBOE page. So these are sort of a subset of those. So the featured trades are always going to be either a covered call or a short put. And they're trades that we think are attractive on stocks that have been doing pretty well recently. We have some behind the scenes stuff that goes on to try to find stocks that have been doing pretty well and typically don't have an earnings date super soon. These trades aren't trying to cater to any particular investor. They're just 3 solid trade ideas using either a covered call or a short put. The personalized trades come in essentially 9 categories. Okay, so we've got conservative, balanced, and aggressive trades across 3 groups of strategies, and those are covered calls and puts, diagonal spreads, and vertical spreads. So you get to 9 by saying, okay, we've got conservative covered calls and puts, balanced covered calls and puts, aggressive covered calls and puts, and then et cetera across the other strategies there. So if you don't like featured trades for some reason, here's some more trades. And they're selected a little bit differently in the sense of we have some different filters that we use behind the scenes to sort of try to meet the needs of this theoretical, right? So the covered calls and puts, we've got, CF, Celdex, and EQT, whereas if we look at the conservative covered calls and puts, we couldn't even find 3 today. That's the reason for this, I can tell you, is the quarter ended last week at the end of March. So for conservative covered calls and puts, nothing that expires after an earnings date. So if you want to hold a covered call through earnings, which will get you a much higher option premium, you need to look at probably the aggressive covered calls and puts. And that particular thing will hold up across the different strategies. There are some difference between like how we select the conservative diagonal spreads versus the aggressive diagonal spreads, but that particular thing will hold up. But yeah, that's how those work. Is we tried to come up with 9 sort of theoretical archetypes and figure out what are the sort of trades that those persons would want. All right, so Jim's third question was, can you talk about how to manage the managed diagonal spreads? For instance, if the sold leg expires worthless, what do you usually do with the bought leg? You let it ride until expiration, you sell a new call against it. What if the sold leg is in the money? Do you let it be exercised using the bought leg? Do you ever roll it out? Okay, so the question here is about the options portfolios. It turns out the diagonal spreads, we closed it, well, it had been a covered call position. It was just a long stock position when we closed it earlier today. Yeah, we closed one of those earlier today for a profit, so now we just have these 2 trades here. And the question is, how do we manage them? So first thing is they're managed. You can follow along and see how we manage them. The other thing is you can look in the trade details. There aren't a lot of notes here yet because all we've done is really open these trades. We do have notes that tell you a little bit about our thinking about what's happening and some instructions. So if you wanted to, you could probably go to the closed trades and find a diagonal spread and see what we did with it. But sure, let's run through these different scenarios. So if the sold call expires worthless, sometimes we just sell the bought leg, right? Like if we can close the trade for a gain after the sold call expires, fine, I'll do that. Sometimes we sell another call against it. It really depends on, right? Like we try to be cognizant of how much capital we have deployed. Okay, so we're not doing a bunch of trades that are going to cost a ton of money. In the diagonal spreads, I try to keep things at $40, $45 a share at most. Yeah, on the diagonal spreads. Covered calls gets a little bit higher just because it's hard to find decent covered calls on a bunch of stocks that are under $50. But we do try to be aware of that. So if I can close a position for a profit, I'm happy to do that. I don't think anybody ever went broke taking profits. But sometimes we will sell another call against it. If I don't think there's a good reason to close the trade, right? Like if I don't think that there's a better place to deploy that capital somewhere else, sure, I'll sell another call against it and maybe either try to repair the position if it's a little bit underwater, or just take another round of premium and then let that roll off. So if the sold leg is in the money, what we do is we try to close the trade for the strike width. Okay, so the way diagonal spread works is similar to a covered call. We're selling an option and then we have some claim to buy the stock. So in this case, this trade that we adjusted and opened today, we have a $60 call and we have a $105 call. So if we were to close this, these options give us the right to buy the stock at $60 and potentially obligate us to sell the stock at $105. So that's 45. We got into the trade for 43. So if we get paid, if we pay 43 to get in and we can get out for 45, that's how you close that most of the time. Typically, I try to avoid assignment just because it's a little bit annoying. Assignment happens at the close on a Friday. So what that means is you're essentially short the stock and long that option position over the weekend. It typically works out okay. A lot of time, occasionally it'll work out in your favor. But especially, right, like diagonal spreads you can do in a cash secured account. It's pretty annoying to get those emails from your broker that you're short a bunch of stock in a cash secured account. So I typically just try to avoid that because it's no fun. And we rarely roll the short legs. Sometimes I will, but I don't. Again, right? Like we structure the trade so it's profitable if that short leg is in the money. So I don't typically see a lot of reason to. I feel like it's fine to open the trade, close it, get out and take your profits, and then go on. Whew. All right, that was a lot of talking. But that was also all the prepared questions. So let's look at some other stuff here. Okay, so in response to at least one question I can see off the top, yes, this is being recorded. Yes, you will have access to it. We will post it on the website tomorrow and send you an email. It'll show up on the news page. You can also find old workshops in the personal finance section. They all have this. That doesn't look like the right banner, but they all have this banner that say apparently new member workshop instead of members only workshop. All right, so John said, what is the best stock to buy right date time? Yeah, I'm not sure exactly what you mean there, John. If you can maybe try to send me a little more. Okay, so Ash K says, bull put spreads seem to be a good strategy in this market. How do I match other strategies with different market conditions? Yeah, right, like volatility is high. Selling premium can be good in this market. You want to be careful of what you're putting those spreads on. Some stuff is really volatile and you can, obviously you can lose when volatility is high. But yeah, in terms of matching other strategies to different market conditions, that's hard, right? So like iron condors, for example, is two of those credit spreads, just one on each side, and so you're betting the stock will stay in a range. I don't think that's great in this market, just because things are moving around real fast. That's the kind of thing you might want to pull out when you expect the market, or at least an individual stock, to be pretty flat. And really, that's kind of how I feel about all of this in terms of, right, like strategies for market conditions. A lot of it's about what stocks in different market conditions, right? Like I just closed a covered call on a fertilizer stock today. What I have now are, right, fertilizer, which is CF, and oil, which is COP. Those are things I don't necessarily dabble in some other market conditions because they tend to be a little bit more volatile, but they're pretty strongly on the uptrend right now. So I feel pretty good putting those on. I tend to try to match stocks to market conditions more than I try to match strategies. I think the strategies can work wherever. Really, you have to know what are the stocks to good. All right, so Samuel said, what's your advice regarding ZIM and the overall marine shipping sector? ZIM has been a pretty hot stock recently, and that is because it paid or at least part of the reason is, let's see if we can find the news story on it. it paid a massive dividend earlier this month. Yeah, I can't find the news story, but yeah, they paid a massive dividend. I think it might be this big move down here is less the stock moving down than just they paid, like I said, just a whopping dividend. Yeah, here you go. Over the past 12 months, they've paid something like 109% of the current share price in dividends. Okay, so that's a sign, right? Like that's not going to keep happening, it turns out. That's not how stocks work. But Zim is also interesting because, all right, asset light container shipping company. Asset light tends to mean they don't own a lot of stuff. So what's probably happening here is they're sort of more of a broker, right? Well, they'll lease some capacity here and then sell it somewhere, or they're doing some kind of other sort of arbitrage there. What that means is they don't own a bunch of expensive boats, but also means that they need to kind of, they tend to do really well when prices are going up, and they can struggle when prices are going down. Which prices going down seems to be maybe kind of what's happening with freight right now. Let me see that. I'm gonna actually just Google that dividend because it was massive. Yeah, so they paid a $17 per share dividend, and the stock was at like 80 something. Okay, so that's a crazy dividend. So a lot of people bought it, right? Like in this run up here to the ex-dividend date, because they wanted to get $17 per share. That seems like a decent thing to do. Now, what happens is $17 comes off the stock price, but if you bought it somewhere around here, you're good to go. But yeah, I think a lot of the freights have been maybe a little bit weak recently. I talked about the truck thing a little bit earlier. Let's just pick another one and look at it. Yeah, see, they're all kind of going down, and that's oil prices going up, freight rates maybe having peaked. You're going to get a little bit of a roll as far as that goes. All right, so with a $5 difference at 100 shares is $500. Yeah, Ashk, if you're okay, let me read this and then so everybody can understand what I'm talking about. With a $5 difference times 100 shares equals $500, but brokers require large margin balance. So too high amount seems to be required for very little profit. This is again about those credit spreads. Yeah, if your broker is wanting you to have more than $500 in reserve, then yeah, I'd ask them why that is. Like, if the most you can lose is $500, that should be the most margin balance you should need. So yeah, that may be a question for your broker or something in terms of why that is why that's a question you're getting. So we got two John questions here. One is, how does Investors Observer Scanner compare to other scanners for day trading? Investors Observer Scanner, yeah, none of our stuff is set up for day trading. It's just not. We have, our sentiment score. I think we have some analysts and other people on staff here who've tried to use it for a little bit of short-term trading and done okay with it, but it's really not designed for that. That looks at sort of action over the last 5 days. We're really just not a day trading shop. We tend to look at sort of swing trading, which tends to be a couple days or a couple weeks kind of holding period to longer. Yeah, so I would say if you have a scanner that's good for day trading, it's probably better than ours for day trading. I think where we provide value is in the the digestibility and accessibility of of this scoring system, but the scoring system is not designed for day trading at all. Yeah, again, right? Like if so options have to be cash secured. So, right, you can't buy options on margin. So they will take the whole 500 in margin balance, but it shouldn't be more than that. If it's more than that, I would find a different broker, because that's just how it should work. I mean, you can do it cash secured for $500 in cash. So why they would need more than that for margin is not clear to me. So John asked, what stock is good to buy right now? John, we don't make stock recommendations on that level, because I don't know. Yeah, essentially, I don't know anything about you or your risk tolerance or your investing goals or your even holding horizon. So that's kind of a question that's unfair for me to even try to answer. All right, so it's a little bit after 5 here, so I'm going to go ahead and close things up. As I mentioned earlier, we did record this. We'll be sending out that recording tomorrow. You can find it on the website. Also, the next workshop will be in 3 weeks, which is April the 27th. If you have questions between then and now, by all means, you can hit the help button and send us an email, and we'll get back to those a lot of times the same day. If you have something that you'd like for me to put a couple slides together on, mention you'd like to see it talked about in the workshop, and I'll put a couple slides together and talk about it in the workshop. But yeah, other than that, thank you for coming. Thank you for subscribing to Investors Observer, and I will talk to you soon.